What's up, guys? It's Cash Flow Cart. Today we are back. This is going to be episode 2 to a series I've started called Dividend Insights. And, kind of not my theme, but my goal for this series is to touch on a few things to get you guys, my subscribers, thinking about what your own personal risk tolerance is for dividend investing. Um, the more you understand investments and the more you understand yourself as an investor, guys, the easier it's going to be to stay committed in this game, to have a long-term approach, a long-term view. Right? It's going to be awesome. I mean, if you're just always watching YouTube videos looking for someone to tell you exactly what to do, um, unfortunately that's not gonna work super well, because if you don't have your own personal conviction in these plays, then you're gonna end up underperforming. You're gonna end up having weak hands. So this is enough yapping, but let's get into this and continue with the series. The first point we're going to talk about is the downside to going all in on JEPI. I've made, I don't know, quite a few videos on JEPI on this channel so far, because for some reason it seems to be, I don't know, the crown jewel of like beginner dividend investing. Everyone thinks that they need JEPI in their portfolio. It's even more talked about than SCHD nowadays, I feel, but let's get into it. The downside to going all in on JEPI. I've made more in-depth stuff about this, but we're going to keep it very simple on this answer. There's two main reasons. The first being underperformance in terms of, in terms of share price appreciation with JEPI. I mean, this is not a point you can argue, guys. We're going to pull up a chart here. I'm on Seeking Alpha. I'm comparing JEPI. This is the orange line being JEPI on a 3-year time frame to the S&P 500, the blue line. Okay, so, you'll see I've charted the price return for each of these securities, and you can see here in 3 years, the price return of JEPI is, just over flat, up 2% now with, I guess, last week's push. And then the S&P 500 is up just over 30% on a 3-year time frame. And you're going to say, well, you need to look at total return. Okay, there's much more to it. You're not looking at total return. Okay, let's do it. We go here, performance. We're going to switch it from price return to total return, right? Update chart. What do we see? Roughly the same total return on this 3-year basis, okay, between JEPI and the S&P 500, guys. I see that. I understand that, but I don't think this is fair, because I don't think it tells the full story. All right. We know JEPI is paying out distributions in the form of ordinary dividends. They're being taxed at a higher rate. And, in order to keep up with the S&P 500, it has to include, 100% of these distributions. Okay. This chart, this comparison is not going to account for all the taxes you're going to, pay with JEPI every single month. When you get that, ordinary dividend distribution from JEPI, that's going to trigger a taxable event. Okay. So, if we could include the tax rate with this graph, I mean, I can assure you it would not look as pretty. One more thing I want to touch on. I am going to go back to just the price return. And, in my other videos about JEPI, I've spoken on the decay, the decay that is basically inevitable with a covered call writing strategy, at least an aggressive or semi-aggressive covered call writing strategy. Okay. When these calls are getting hit, their strike prices are getting hit, that limits upside. And everyone wants to argue with me in the comments. You're not looking at it the right way. Guys, like, we can look at it on a graph. Okay, we can look at it with this chart. Okay, and that's what we're gonna do. So this chart starts in late January of 2021. I'm filming this in late January of 2024. It's crazy that 2021 was 3 years ago, but anyway. So we see what happens. JEPI and the S&P 500 are both on an uptrend until about, until essentially the end of 2021, right? Just in this first third on this graph, we can see an uptrend in both. It's more aggressive in the S&P. It's a little less aggressive in JEPI, but it's there. I'm not arguing with that. Then what do we see? 2022, as we all know, that was the 1 year bear market, right? And we've talked about this on the channel. 2022 was essentially straight down in a downtrend, in a bear market, whatever we want to call it. Fast forward, beginning of 2023, the sentiment flips and the S&P 500 is able to have a great rally. Fast forward to now, the S&P 500 has broken 2021's high in terms of price return. We look at JEPI, it has not. Okay, so do we see how the S&P 500 has the prospects and has the ability to recover fully because it doesn't have this covered call writing strategy, layered into it. Whereas JEPI, it's not able to recover. Okay, and I think just with this illustration, I'm able to better make my point kind of about that decay that you're going to see with any sort of covered call writing strategy. Okay, guys, and at JP Morgan, they're going to do some fancy things. The covered calls are going to be in the form of ELNs or equity linked notes. And I think a lot of people are getting confused, thinking that this is some special superior covered call writing strategy. But I can tell you with 100% confidence, any type of aggressive covered call strategy, no matter how it's packaged, it's going to underperform because of that decay, because of that limited upside potential. Okay. Do we understand that? That felt like a bit of a rant, but one other point I'm going to touch on JEPI. I said there was kind of two main reasons why I would not go all in on JEPI, why I personally don't even own it at all. I get if you're older than me and you need the income, maybe you want to look a little closer at it. For me, I'm not touching it. Kind of in this space of dividend growth investing, I guess people have kind of, place this JEPI ETF as a dividend growth investment, guys. It is not. Okay, this one is not guaranteed, and it does not even have the track record of dividend growth, nor does it have some sort of smooth monthly payments. With a strategy this active, it's going to be hard kind of for JP Morgan to kind of dial in on consistent monthly payments. And let's look a little closer at it. Okay, so we can see the first paycheck from JEPI came on July 7th of 2020. I guess the inception date for this one is 2020. We can see that was an ordinary dividend to the tune of 49 cents per share. Okay, 49 cents a share, July 7th, 2020. We fast forward, we look at the same month, same date, July 7th, 2023. It's just under 36 cents. Okay. Do we understand that this one does not have any sort of guarantee to grow their dividends year after year? And, if we look at some sort of covered call ETFs that have been around for a little longer, we do see that oftentimes what happens is the general trend in the long term is, smaller dividend payments with time. I mean, it might take years, but the dividend growth is not there, guys. Okay. This is a matter of how well their strategy is working out, how aggressively they're able to write these covered calls. And we can see kind of with that, you limit this idea that, You can have dividend growth, you can have greater yield on cost, any of that, guys. Let's not get carried away with JEPI today, because if you've been with me on this channel, you definitely know I have a tendency to get carried away with JEPI. All right. We're trying to make this as unbiased as we can, guys. Again, I want to challenge your own personal views. I mean, if you feel inclined, I'd love to hear from you in the comments. Let's move on. Dividend reinvestment at higher prices. Again, we're going to keep this pretty high level. So this guy's asking, drip at higher prices. And he said, why is Fidelity reinvesting my dividends at a price that is 20 cents higher than the high of the day? Horizon reinvested on January 11th at $13.75. The high of the day on January 11th was $13.58. So, he's referring to kind of that slippage, or, you might get higher fills than you think you should with dividend reinvestment. And, not to dig into Fidelity or anything here, I'm just going to kind of give my personal take on DRIP. That's a dividend reinvestment plan. Personally, guys, I do not like to drip. For me, this is my take on it. Any new capital that I'm investing into my portfolio, from my paycheck, I try to put some money in, try to get in that good habit, or any cash that hits my portfolio in the form of a dividend payment. To me, those are no different. Those are not different. Those are not different resources. Maybe they come from different places. They come from my paycheck, set a little aside, or they come from a dividend and it hits my account. I'm using all that capital, wherever it's from, I'm using it to find my most opportunistic prices. Every share that's in my portfolio is for me getting in my account and hitting buy, selecting how many shares I want and hitting buy. And we don't need to pull up the charts in this video, just because I said this is a little more high level. But, I'm sure you guys have seen Microsoft's performance lately or Apple's performance lately, two that have been very much so outperforming the market. When I get the dividend checks from companies that are outperforming, that I've already built that position in, I don't want to reinvest at those inflated higher valuations. No, I don't want to do that. Okay. Not to mention the slippage that you might incur. Instead, I'm taking my pool of capital and I'm putting it in the best opportunities I can find, right? Okay. And that's kind of my take on DRIP. I don't have to deal with slippage. I don't have to deal with any sort of fee, that might be incurred with using some sort of reinvestment plan, guys. This is my take. Okay. If you disagree, it is what it is, but I just tried to explain how I sort of look at it. Let's move on. This is a great point. Okay. This guy said, annoying how most most sock coverage is over your feet. Annoying how most stock coverage is about growth. Okay, so, this guy wants news on his stocks, but, 99% of the alarmist buy, hold, sell recommendations are based on, yada, yada, yada. Let's talk about this. And I don't know if a lot of you guys are, prone to watching kind of, stock news on TV, keeping up with that stuff. Heaven forbid you take advice from Jim Cramer, but there's something that we need to keep in mind whenever, we've got something on TV related to the stock market. And here's the bottom line, guys. If it's something on TV about the stock market, great, whatever. They can bring in this analyst, they can bring in, this guy, this trader, whatever it is. At the end of the day, it's on TV. It's part of the entertainment industry. Okay. And, in order to have kind of a successful show or whatever, they benefit from kind of instilling emotions in, watchers. So if they can scare investors, if they can kind of get investors addicted to kind of this keeping up with, oh, what's happening, what could happen, I'm scared, is a recession coming? Guys, that's they make money. They make money from more eyes, more people on the edge of their seats. Okay, so here's my kind of take on this kind of news thing. I stay updated with news about holdings that I have. Okay, so I have portfolio reviews, but I'm a shareholder of Apple. Anytime there's specific Apple related news, whether it's one of their events, their Apple Day, whatever it is, I'm updated. Earnings come out, I'm checking new numbers. I try to stay away from news about like broader stuff, because if you want my honest opinion, a lot of these guys are yapping. I post 2 videos a week on this channel. Videos are between 20 and 30 minutes, and it's like, I honestly feel for this long-term type of investing, I feel like I can cover or address everything that needs to be covered. I don't need, a show running 24 hours a day, instilling fear in my viewers so they keep coming back. They keep getting their fix. They're all right, let's move on. Lump sum of 200K. I don't know if this was a theoretical. This guy said if you were in your mid 30s and had a lump sum of 200K to build a snowball, what would your portfolio look like? And I'll say there's kind of 2 schools of thinking with this, and I'm going to be particularly in one school of thinking, but we're going to cover both. And this is a question of you understanding your own personal risk tolerance as an investor, guys. So if you have 200K in your mid 30s, one route you can take is kind of trying to get a low expense ratio ETF. He said he's looking for that dividend snowball. So something like SCHD, would probably be beneficial. Noble, that's NOBL. I mean, you find a low expense ratio ETF. If you want to lump sum it, you do it and you set it and forget it. Guys, that is definitely one school of thinking. I understand that. Your risk tolerance is you just want the money to be there, to compound, to track the market, and to provide a growing stream of dividends. Your best case here is going to be kind of the ETF route. The other school, which is me, guys, I like to look for individual stocks. Okay. I put a lot of time, I put a lot of effort into researching and, screening for dividend stocks, trying to find those companies that I think are going to be kind of that sweet spot for yield on cost. And for me, if I had a lump sum of 200K right now, I would definitely look for, X number of stocks. I'm young, I'm 22. So, I could get away with a lower quantity of stocks, guys. I have 8 holdings in my portfolio right now. If I had 200K, I'd probably beef up some of those 8 holdings that are at attractive valuations still. And then maybe I'd, add some new positions as well. So I'd probably go from 8 holdings to 10 holdings in the portfolio. Again, these are individual stocks, seven tickers, 1 REIT. And, being 22, I am okay with this leaner portfolio because I want to know what I'm investing in. I keep saying it again and again. I want to be opportunistic with my capital. And, people get on here, and I'm pretty active on Reddit too, as you guys can see. And they say, this is under diversified. This is not enough holdings. Kind of my rebuttal to that is, okay, if I have 8 companies that I can understand, that I can find, good entries based on valuation, that I have conviction in, that I want to build out, to me, that is plenty of diversification, guys. Again, I'm going for that outperformance. I'm going for, the outperformance in share price appreciation, as well as outperformance in terms of a growing stream of dividend income, guys. All right. I'm hungry, and with that comes I may have to take on, you know, some risk of not having exposure to 200 different companies because I'm using only ETFs. I'm not using ETFs. I'm picking stocks. This is my strategy. This is my investing philosophy. And, let me know if you guys feel similar or if you are somewhere between kind of the ETF school of investing, stock picking. If you like to blend, maybe you're mostly ETFs, but you see one or two stocks that you're like, okay, these are great opportunities. I'm going to sprinkle that in, whether it's to boost my yield, whether it's to boost my, dividend growth prospects. Guys, I want to hear from you, right? I mean, the support's been awesome on the channel. I appreciate each and every single one of you. We've touched on situations like this before. AVGO, that's Broadcom. Obviously, if you guys are dividend growth investors, you're familiar with this ticker and the share price performance it has had, in the past 5-6 years. It's been a powerhouse, as well as the dividend growth has been a powerhouse. But, unfortunately, with this share price appreciation, for those of us that haven't been in this one, it's hard to get involved. It's hard to justify paying, kind of the valuation it's been at. We won't look at the numbers, but I encourage you guys to look at this one on your own and kind of see what you think. This guy said, I bought AVG a while ago and it's up 400%. Let's pause there. Awesome. Okay. You identified an opportunity in a dividend growth name, and it's working well for you. You have probably an amazing yield on cost right now. They're continuing to grow that dividend. That's the name of this game. Okay. So I'm going to stop you right there. All right. But now this guy's thinking, what should I do? I'm up 400%. What do I do? Sell, trim, hold? I love the dividend growth, but the valuation has me concerned. Perfect. Right here. I love the dividend growth. Okay. We are dividend growth investors. This is what we do. Having huge paper gains, that's probably just going to be a byproduct of, okay, you've identified great opportunities, guys. In my own case, we've touched on Microsoft, those paper gains. We've touched on the Apple paper gains. I'm sure we've touched on some others, but this video is not about my portfolio, guys. Do not sell because of paper gains. If you are a dividend growth investor, guys, you're going for that long-term yield on cost, that long-term approach, having a growing income stream. Guys, you got to ask yourself, what type of investor am I? What's my philosophy? What's my strategy? The only reason I would say it would be acceptable to sell or trim is if there's a material change kind of in that company, in that underlying company. Okay. Maybe trim if a position just gets, to be a huge part of your portfolio. But even with that, I can't even really justify that. I mean, if you guys look up Warren Buffett's holdings, I'm not going to give it away, but if you look up Warren Buffett's holdings, you'll see if you have a quality company, that you believe in, that you've identified and you've built out the position, that's okay for it to grow and to make up a bigger part of your portfolio. Okay, guys, this is not, we need these ones that outperform. We need these great picks. Why do we want to get rid of them? I don't know, but I will say I understand the temptation, guys. I've been here before, and I've fallen victim to this on something like AbbVie, selling that one after my 2019 entry. Selling that one was probably one of my bigger mistakes in dividend growth investing, because I'm sure, as you guys know, AbbVie has been like another powerhouse of dividend growth. Okay. So, let's not beat a dead horse. I'm having fun with this video. I like how we're kind of, we're keeping it light. We'll see where I go with this series. Maybe one episode a month, or I don't know. If you guys like this, let me know. If you just like more serious, one topic at a time videos, that's great too. I mean, but again, guys, thank you for joining me today. It's been great. 2024, my year's off to a pretty solid start. I hope you guys are in that same school. I hope you're continuing to build your portfolios, to study this game, to understand yourself as an investor. And let's build wealth. Let's finish this year strong and subscribe. That'd be awesome. Thank you guys so much and take care.